Phil, man, welcome back. Big pod today. Big pod today. Sorry, man, I can't hear
How's
you.
it going?
Oh, you're back now. Sorry,
Good.
we couldn't hear you in the beginning.
Oh, okay, I was saying I was jealous I missed out on the meeting with you guys in Anush as well.
Yeah. Of course, we missed you, man. We missed you, but
Yeah,
that was a big one. But like, I think today's even bigger because we're talking about maybe potential property price, maybe correction, maybe crash.
yeah,
There's a lot
yeah,
of negative news and headlines, so we're going to
mhm,
cover like the biggest topics of Q1. Obviously, we've got geopolitical tensions. We've got a lot of proposed changes to property. So this one's a big one, and we're talking about pretty much all these effects on the property market and what we see as the most
yeah,
likely outcome. So
yeah,
I think if I can just lay the scene, man, I mentioned before I want to kind of go on a slight rant today. I normally don't do this, but it is a bit frustrating what's happening in the world, and obviously we don't like to see these tensions and loss of innocent lives and everything else. It's a very sad situation. So first of all, like very terrible situation is happening. So sorry for everyone that's affected. Sorry for any families that are affected, but at the end of the day, it's out of our control again. So these are events that are occurring due to some world leaders doing some crazy things, but they are happening and it has an impact on everyone's lives. And I think the main thing we're talking about today is the first topic I've been getting asked a lot is, how is this crisis in the Middle East, these tensions, how are they going to impact property prices and the lives of everyday Australians?
yeah,
So the main thing I want to start off is number one, it's going to impact a few aspects of our economy of property of everyday lives for most Australians, and that's because it in fact impacts inflation. And what's really saddening to me is what people don't understand, especially the RBA, they don't understand this. I think the RBA is being very kind of reactive instead of proactive here. I don't think they're having the foresight to see what's the likely outcome a few months ahead. I think they're just being, oh my God, this will cause a spike in inflation. We need to act now and do the one thing they can do, which is only lever they have, which is to raise rates. So,
mhm,
like, if you ask me, like, the recent rate hikes from the RBA are the exact opposite of what should be happening in the economy.
yeah,
What's happening right now is with this geopolitical tensions, we are seeing oil rises spike significantly. Just to put into perspective, end of last year, oil was like around $52, $53 per barrel. It spiked to over 115, $120. It's corrected a bit, but it's still significantly higher, like 40, 50% higher than, Q4 last year. But
yeah,
what people don't understand is the spike in oil prices, it's not inflationary. And hear me out here. It's not long-term inflationary. It's actually the
yeah,
start of a very deflationary event.
yeah,
Short term, all prices will cause inflation, obviously. That's the standard thing you'll see. But in reality, this triggers the deflationary event we're about to see with the flow-on effects in the economy for sure. And I don't think the RBI understands that. So when we see the next CPI reading, guaranteed all prices are going to increase, like your headline inflation for sure. But what's happening is obviously oil is a major output for energy, for all the production in the world, for fuel. So it has a large weighting on CPI readings. But what people don't understand is, especially the RBA, the oil is not a reflection on Australian spending. It's not a reflection on our consumer spend. It's not a
yeah,
reflection on our economy getting stronger because oil prices are rising because of geopolitical tensions, because of just crazy world leaders doing irrational things. So what we're seeing right now in the news, and all the four major banks are now predicting there could be consecutive rate rises in a market where these oil prices are already going to impact everyday Australians from a fuel perspective. Small businesses will get impacted, transport industries will get impacted, airlines are going to be impacted. This impacts all the manufacturing costs for goods. Prices increase even more, and we're in a massive affordability crisis.
yeah,
So raising rates in this environment is not going to solve inflation, in my opinion, because it's going to hurt the economy more. You're actually kicking the Australian consumer when they're down.
yeah,
Oil prices rising as a result of war is nothing to do with the Australian consumer. So I think the RBA needs to understand that they should actually be thinking of this in the opposite way, because what happens as a result of all these manufacturing costs and the cost of production increasing? Everything becomes even more expensive and consumers can't spend.
mhm,
If consumers can't spend, what happens to the economy? The economy slows down.
yeah,
When the economy slows down, we need stimulus. We need actually rate cuts in the economy. This is not a situation where the RBA needs to be thinking, short term, oil is creating inflation. We need to go out there and do anything we can by raising rates and then think we're going to, fix this inflation problem. Even
yeah,
before this global conflict was starting, the hot inflation report, I think in January this year, we had a hot reading because of two main components in the data. Number one, rental market. The rents were increasing. Why are they increasing? Because there's a massive housing crisis that the government hasn't done anything to fix, to be honest. They've made it worse with their first home buyer schemes and lack of building approvals and the building homes. And I can talk about that a bit later, but that's nothing to do with the average Australian consumer. And luxury spending was the other component in Q1 that drove inflation. Luxury spending means your top percent of wealthy people, they're still spending in as they desire because they can afford to. Because
Yeah.
that's just the way the economy is. It's a K-shaped economy. We've got 10% of the wealth, 10% of the people controlling the majority of the wealth, and the remaining 90% that can barely survive day to day. So now we've got a situation where that's already the case, and now it's even going to be harder for the middle class. And the RBA is thinking of consecutive rate rises. So this isn't going to fix anything. It's going to make things worse. It's going to slow down the economy significantly, in my opinion. And then they'll look, pretty stupid down the line, 3, 4 months, maybe 6 months down the line, when they're thinking of cutting rates as soon as possible because we're seeing a slowing economy.
Yeah.
And yes,
Yeah.
there will be a flow-on effect to property prices, obviously, because rates are rising. And like we've been talking about for a while, where we're focusing on for our investor clients, so from an investing point of view, affordable markets with low supply, high demand, the right fundamentals, they're still not going to be affected. It's that price range that's more affordable, starting from the 1.3 to $1.5 million mark, that will see this effect come into play, where because of rising rates, because of a slowing economy, because maybe unemployment rates rise as a result, those prices will become more affordable and they will correct. And we saw this in 2022. In 2022, we saw the most unaffordable markets across the country correct. Some of them still haven't recovered. In Sydney, we were looking at your Mossmans, your Vaucluses, your Lane Coves correct like 20%, millions of dollars of the previous sale prices. So that might happen again. But we still saw amazing growth in more affordable locations in 2022. But ultimately, like this war will affect everyone in a lot of different ways. And inflation will continue to increase, continue to go higher. And it's all about just understanding that, yes, there will be, impact to some property prices. Asset classes like the equity market, the share market, the stock market, they're all-time highs. They're starting to correct now. That's even more risky, in my opinion. And we can see that in what's happening with those markets today. So in an inflation environment, when your money's not even growing for you, where do you look to invest? Property is still a great bet and a hedge against inflation, just like gold. So these are things we have to consider. But yes, all up, it's ridiculous in my opinion what the RBA is considering to doing, because it's got nothing to do with Australian inflation, especially when discretionary income is like at an all-time low today. Raising rates is just going to make things a lot worse. What do you think, man?
I think they're being a bit robotic, right? Like
Yeah,
you said, they're just reacting to what's there. They know what the playbook and they're just pulling on the levers that they have, right?
yeah,
Now, I've seen record unemployment. Unemployment is very good. But if you ask day-to-day people, like you said, that 90%, a lot of them want better jobs that they can't. A lot of them are forced to work just because they're basically stuck between bills or living paycheck to paycheck.
mhm,
And the perfect example that you said of, oh, they're looking at inflation going up because everyone is spending more. If we're inviting 500,000 people a year into the country and things like oil and coals and Woolworths were going to court about record prices and our all-time high stock market is at record highs, but the economy isn't actually developing and isn't actually really functional or really positive, right? Now, we don't, I saw a post the other day saying, most smart Australians end up in property because that's where a lot of the money is. And that can be a negative. We don't want someone that's really good at other fields going into something like property just because, that it's so lucrative. And that's not an economy that's really developing and that's going to develop, right? It's good that we can fit people in. But if we're not actually reaching our building codes and building standards,
yeah,
how are we actually going to maintain that? Now, the what you said with oil and petrol prices going up, that's not just your car. That's, things coming into the country. That's even Uber Eats. All your Uber Eats orders are going to be more expensive
yeah,
now. Now, it flows on to so many other things. And if Coles and Woolies are at record high prices for our groceries and they're blaming COVID, what's going to happen now? And just because things are more expensive, people are actually buying less and spending more. So it is, in a sense, like you said, a cyclical trap where they're just seeing the numbers of it increasing, but it's not actually reacting in people's lives where, like you said, the top are living how they're living, but everyone else is living worse and worse. So that's something that doesn't look like it's changing. Now, they say, okay, well, if we increase rates, like you said, properties will go down. Properties that are worth $5 million, sure, they'll go down. But properties that are in the price range that people can afford, you're just battling against people that are within your kind of structure and in your status sphere. So
right,
if they're going to be down, right? Someone else is going to outbid you and they're going to try to bring it back up. Whereas when you're looking at the $5 million properties, like you said, or the examples that you use doesn't really need to be that expensive. Anywhere between 1.5, you've already cut out so much of the market. So that price point, maybe, but that doesn't affect most Australians.
100%, man. And like these, the issue is the RBA doesn't also understand if they see any economic weakness, historically look back at every slower economy, every recession, what's happened to oil prices? They've absolutely crashed. They've
Yeah.
crashed. You've seen like 2008 financial crisis, oil prices went to like, all-time lows. In 2020, during the pandemic, what happened? Oil prices
It
went
went
negative.
negative.
Went negative.
They,
It
they
went
didn't know where to
negative.
put
So
it.
what are we doing here? Like, why are we
Yeah.
thinking that making, a decision based on rising oil prices, which has nothing to do with the average Australian consumer today, is going to fix inflation? To your point, they're not building enough homes. So a lot of the inflationary component today is rents, it's house prices. So there's nothing being said about, the government, not meeting the build targets. That's a whole different story. I don't think they're ever going to build that many homes, to be honest. But the issue is there's still, you mentioned, they're bringing in 500,000 people a year. Now, you can maybe look to bring in that many people if, you can support them with housing, but we haven't proven we can do that. There's
Yeah.
no policies tying the amount of migration coming to the country with the supply that's being created either. And we already had a massive housing shortage. So there's no accountability for the government. And you mentioned, unemployment rates are pretty low at the moment. Yes, they are. But why is that? Because the government's been spending an insane amount of money,
Yeah.
especially on, sectors in the market, like for example, NDIS, that aren't necessarily lucrative, that
Yeah.
aren't even providing economic growth.
Yeah.
So all that spend, it's all inflationary. And the RBA isn't even talking about this. What they're
Yeah.
talking about is a crisis that no one has control over. A bunch
Mm.
of crazy world leaders have just, created this issue, and then everyday Australians are paying the price.
Yeah.
And
Yeah.
now looking at consecutive rate rises when, people are already struggling to just to fill up their car. I'm having conversations with people who don't want to go outside, don't want to drive to work anymore. They're trying to work from home
I
just
want to
because it's
save
already too
petrol, right?
expensive. Exactly, they want to
Yeah.
save petrol. And
Yeah.
like this effect will again, in fact, impact everyone as this,
Yeah.
crisis continues, as this war continues. But longer term, I'm talking not even that long term, 3 to 6 months down the line, I can bet you anything when we see some kind of solution to the war, or it doesn't even have to be a solution. The war can keep happening, but once the economy starts to weaken, all prices will decrease
Yeah.
because that's a result of consumers spending less. Businesses are stopping production, and what happens then? There's no demand for oil.
Yeah.
There's less demand
Yeah.
for oil essentially, and the oil will price in, um, you know, events that are going to happen 6, 9, 12 months down the line very quickly because it can see that decrease in demand, just like we've seen in the past many times.
Exactly.
And instead of the IB understanding the past trends, they're just trying to think, oh my God, this is all inflationary. We can, take the
Yeah.
blame away from everything that the government's doing and, just put it on the war.
Yeah.
So yeah, I just don't think they're ever being, proactive. They're never looking, 2 steps ahead. They're always kind of chasing their own tail. And I don't think they're making the right decision personally. But
Yeah.
yeah, we'll see what happens, man. But like I truly believe that the most likely outcome is they will raise rates.
Mm.
And it will be the wrong move. And in a few months, maybe towards the end of the year, they'll be cutting rates again, in my opinion, because it will slow down the economy for sure.
Yeah.
Yeah.
And the ripple effect will be on smaller towns outside the major cities because they're already struggling now.
Yeah.
And like you said, if we're looking at people from Sydney that are getting priced out of Sydney, what's next, right?
Yeah.
It's going to be a regional town potentially, right? It could be still a good positive regional town, not to say a random place in the middle of nowhere, but those locals are now being outpriced on places that they grew up in, right, by people that are within those capital cities. And there's nothing really that's going to change that. There's nothing really that's going to
Yeah.
impact that. They can say that they're building better transport and better infrastructure, but nothing can really happen that's really that visible and tangible for people to feel confident in.
Correct. Yeah, 100%. I think that's more a statement from maybe even your job and like, your lifestyle. I think
Yeah.
if we're talking property, if those locations are still relatively affordable, it might not impact as much, in my opinion. Because ultimately, like we talked about before, like will this impact the entire property market? No, it never
Mm.
will.
Yeah.
We have a massive supply crisis. We've talked about this. So there's a massive floor in pricing.
Yeah.
So even though, everyday Australians might feel, hey, I can't afford to buy property today. Well, the harsh truth is there's enough buyers in the market, especially in
Yeah.
the more affordable locations. And we're seeing that. We're seeing that in the data. We're seeing that with what's happening in the market. They're still growing
Okay.
at like 20% a year, to be honest. So they're
It's
outperforming for a
crazy.
reason. So because
Yeah.
it's still relatively affordable in the right locations, there's no kind of catalyst yet, even raising rates to stop that demand.
Mm,
There's still a big rush towards property because even if it's not from
exactly.
an investment point of view, people understand this will keep growing long term. They understand the
Yeah.
fundamentals. They still see that this is pretty much the last chance to get into the property market. We've been saying that 2026, it's the last time to buy in a major capital city under $800,000.
Yeah.
For houses across capital cities, the median price is now $1.2 million. $1.2 million. So I'm very confident that 85, 90% of Australians can't afford that price point today.
Yeah.
And even if they
Yeah.
can, paying your mortgage is close to impossible with
Yeah.
your bills, expenses, lifestyle, kids, whatever it is. So it's understanding what markets will be a risk, preparing yourself, to see how you can de-risk your situation if you are involved there. And then obviously, if you are looking to invest, if you look at all the asset classes across the world, Australian property is still very relatively safe. So if you're looking at the right fundamentals, you're going to the right locations, you're still going to outperform numerous asset classes. You're going to outperform the Australian market itself. But yes, if you're buying unaffordable locations, you probably will see declines in those properties,
Yeah.
and that will create more opportunities in the future. Maybe not in the
Yeah.
short term, but in the future that will create opportunity. But this is the way
Definitely.
we're viewing, the effects on, oil prices rising, these tensions on the property market itself. But it's an inflationary environment. What wins in inflationary environments, because the value of the dollar will keep on declining. That's very crucial here. Hard assets, strong growth, hard assets are going to be key to
Mm.
surviving, in my opinion.
100%. 100%. Just try not to make your money lose money, really, right? Where you're going to park it, where it's going to at least maintain the inflation, where you're not feeling like you're constantly losing money the more you
Yeah,
earn and the more you save, right? So
correct.
a lot of people do get stuck in that where they think, they still wait for the prices to go down and wait for them to be affordable, and it just
Yeah.
doesn't happen that way.
Doesn't happen. Exactly. Exactly. Because the fundamentals are there in the right
Yeah,
locations. That's ultimately the
yeah,
case. Yeah.
yeah,
So I
that's
think
right.
I think we covered off the war topic a bit, and everything ties in here because we've got some pretty negative headlines in Q1 towards
Yeah,
property. So we're just trying to debunk. And
yeah,
obviously these will have effects. We're not saying this is not going to affect your life, it's not going to affect the property market. No one's saying that. But
yeah,
what we're saying is that there are the right locations, the right growth segments in the market that will really do quite well. And there are other
mhm,
markets that, if you look at the fundamentals there, the affordability metrics, you're going to see declines.
yeah,
It's guaranteed almost
yeah,
by the way the
yeah,
market's going.
yeah,
So then
yeah,
obviously with the housing shortage, man, we've had a lot of, talk about the next budget, some of the new
yeah.
policies they're kind of looking to enforce. So maybe you can start with this one. What is your opinion on proposed changes to negative gearing?
So I know a lot of people say, "Oh, it's not fair. All these rich people, they get all these outs and they can skip
Mhm.
paying tax and they want to save money."
Yeah,
But every time we've seen that happen, we've seen rent get more expensive and
yeah,
houses not get built,
yeah,
right? We already can't find people to physically build the houses, let alone have people interested in pay and funding them as well, right?
mhm.
One of the biggest issues right now is really that. Now, from an investor standpoint, right? If I don't have negative gearing, I've lost a few $1,000s a year. I'm not going to one, maintain my property to a higher standard because I want to save money,
Yeah,
right? And cut costs wherever I can. And two, I'll be less incentivized to maybe build a granny flat that will invite more people
mhm.
or, build another property or invest in another property and develop that,
Yeah,
right? Because all these costs are going to come into my bottom dollar and I'm just not going to not spend it.
mhm.
Now, if the costs are to make a higher rental return and a better property, I'd be more incentivized to actually invest in that property as well. So what I really think is going to see is rentals are going to have more expensive rents and lower quality rentals. I
Okay.
think that's what's really going to happen,
Mhm.
right? Now, I know they said they had a cap on potentially having two properties,
Yep,
as in you can only negatively gear two, and then anything other than that is fine.
yep,
But you're just asking people to start manipulating with their finances and just
yeah,
finding loopholes to try to cheat that.
yep,
And realistically, not too many people own more than two,
yep,
right? There is a small percentage of investors that own 3 to 5 to 6 properties, right? They do obviously exist, but a lot of the clients that are in that bracket, they do have some sort of negative gearing, but I'm sure I couldn't tell you, but off the top of my head, maybe you would probably know. The percentage of those people is very low. They're not
yep,
really the ones that are bailing out. Maybe the top 1% are definitely taking advantage,
yep,
right? But this is a really small number of people
yep.
where these changes aren't going to really have a big everlasting effect on everyone. Really, I don't see a situation where getting rid of it makes it actually better for investors and people renting.
Yeah, 100%, man. I think I agree with a lot of your statements. And if you like kind of like take this into multiple, layers pretty much. So let's say
Yeah.
you do remove negative gearing or you're restricted to two properties. What's the first thing that happens? Well, investors look at their portfolios and they look at the assets that are bleeding the most cash.
Yes.
Negative gearing or not negative geared, like, if you can't claim it or you can claim it, you're still losing money, essentially.
Yeah.
So if you've got a property portfolio and you've got two or three or four properties, whatever it is, that are negatively geared, they're bleeding cash. So you might look then to cut those assets out. And what assets are they most likely to be that are going to be negatively geared today? They're going to be your more unaffordable assets.
Yes.
Properties under $800,000, especially if you bought a few years ago, I doubt you're negatively geared, or I doubt you're, bleeding cash
Yeah.
from these deals for sure. If like we've been buying in some of these locations and prices have doubled, but when we were buying them, rental yields were about 6%.
Yeah.
So they're not negatively geared properties today. So again, the more affordable market is not even impacted, or most likely
Mm.
not impacted by this change. What really is impacted is properties maybe above 900 to $1 million, above that price point, especially for example in like blue chip Sydney or blue chip Melbourne, even now blue chip Brisbane, and they would be bleeding maybe 35 to 50 grand a year. And obviously, your more wealthy investors, people that you're managing their incomes and the tax strategies, they're leveraging their negative gearing as a strategy to offset that.
Yeah.
But they might already have a portfolio, in different structures, like a trust structure or something that's, fairly cash flow neutral or positive. So what's going to be impacted again is your more unaffordable range of properties. So every time you've seen any changes to negative gearing or similar type of policy changes, the market as a whole has declined maybe 2 to 3% as a maximum across the entire Australian market. That
Mm.
doesn't mean every suburb declines 2 3%. That means
Mm.
from a median price point perspective, the market declines slightly. And what drives that? More unaffordable market and suburbs,
Yeah.
because they have a large influence on those median numbers. And why do they decline? Because obviously investors let them go because they can't get the same tax incentives back. So
Yeah.
the more unaffordable market here is at quite a high risk this year, as we can see, because if this change does come through and rates are rising and our negative gearing policies are also kind of, taken away from investors, people will be selling those properties. That's
Mm.
a fact. So
Mm.
this is even more crucial today to understand, not just affordable in terms of price point, but relative affordability. So, an unaffordable property in Townsville is very different to an unaffordable property in Sydney.
Yeah.
They don't have the same price points, they don't have the same fundamentals. So we need to understand different metrics, different markets, because at the end of the day, the market is on hard mode investing today. You've got a lot
Mm.
of changes coming to the market. You've got RBA raising rates. You've got geopolitical tensions. You've got other asset classes declining. So there's a lot of fear out there, and people emotions are a big part of any price movement as well. Because when people get scared, they can exit. Property is more
Yeah.
illiquid. It's not easy to exit. In a very quick fashion. You can't just quick sell like in the stock market, but you can exit.
Yeah.
So you have to understand that all these effects, unaffordable properties today, will have a big impact. We're having the same conversations with our clients today that might be looking to buy a property in Sydney, above $1.5 million. And we're saying, look, with what's happening in the market today, there's no real rush because the market will likely remain flat, maybe even correct a little in those pockets. That's just the most likely outcome. I'm not saying that's a guaranteed, probability that a possibility that's going to happen, but we're just looking at data. We're just saying like more unaffordable pockets are at high risk this year.
Yeah. Yeah.
And again, that's a relative term because every single city, no matter how low the price point is, has unaffordable locations, which can
Yeah.
all be a risk here. So from a negative gearing perspective, yes, ultimately you're right. If investors are forced to sell certain properties, maybe yes, then you will get owner occupiers buying those properties, but then your average renter who wants to tenant out that property might not be available for them. And what
Yeah.
happens then?
Yeah.
There's more issue with rent. So ultimately, I think this will impact rents more, and rents will always keep going up long term because there is a supply crisis. And no matter what change they're trying to make, there's no end to that, in my opinion.
And the data speaks for itself, right? Because you're exactly right. The first start of the year, Melbourne and Sydney have been, by percentages, probably the least performing capitals,
Correct.
right? Now, if we take that again with the example that you said, if investors are leaving the market from
Yep.
the upper end type of properties, then as you said, rent is going to come up. You might see a 2% decline or a slight decline, but
Yep.
there's just going to be an elastic effect where it's
Correct.
just going to be a lag effect where it goes back and potentially becomes even more unattainable.
Yeah.
And now
100%.
when you're just starting out and you can't even afford to live in Sydney and you want to rent invest, that takes a lot of our rent investors as well, right?
Yep.
Because they've had a way that they could invest and save on tax, and now they can't. So that makes it actually even worse for those people as well that are in that bracket.
Yep.
And really, that actually does, tie into the war. right? Because how good is living in Australia, right? We're so far away from everything. We're so far away from the problems. When everything happens, we just dig some rocks and we find more things in
We're
it.
blessed. We're
So
safe. We're very safe. Yeah.
yeah, so just that safeness alone is
Hmm.
really going to put pressure on our housing supply. It just
Yeah.
is what it is, right? We've
Mhm.
already got the Iranian national team trying to stay in Australia as well, and they're not going to be the only ones, right? When the world's crazy, people are going to go. Even, people in Europe or US, it doesn't even need to be a country that is actually going through strife. But if you
Correct.
can go somewhere that's more safe and more wealthy,
Yeah.
that can definitely happen too. And you're just going to see that yo-yo effect. So I really think negative gearing is a really good thing for most Australians.
Yeah, yeah, man, I agree. I don't think like there's any need to make these changes. I think they're kind of just taking the attention away from, hey, we're missing our supply targets.
Yeah,
Hey, we've still got this crisis, but like it's let's blame on the investors.
yeah, yeah,
Ultimately, I'm not saying it's a good thing to own 100 properties, by the way. I'm not in that mindset either. But investors are good for the market because they create a rental market.
yeah,
Without investors, there is no rental market. And as properties become more unaffordable, people need rental properties because in a few years' time, unfortunately, a lot of people won't be able to buy. So you
yeah,
need a rental market. So it
yeah,
needs to be a fair balance to, all things, all sides, homeowners, investors. But ultimately, the main issue is there's no supply. And
yeah.
I think instead of directly addressing supply issues, instead of directly addressing, how we can build more homes or, take out the bottlenecks from the approval processes or make sure migration policies are tied with supply incentives, it's like let's look at everything else for whatever reason, which is
Can we blame? How can
yeah,
we start some fires?
exactly. Yeah, yeah. It's terrible, man. But and the last thing the budget's talking about, this is the last question we'll cover today, which I've also been asked quite a lot. So obviously proposed changes to CGT. So
Mm,
obviously, right now with capital gains tax, that is CGT. So right now, if you are holding an asset for more than 12 months, you do receive a 50% discount on the taxes you pay. Within 12 months, you don't. So the
yeah.
changes are to remove the CGT tax discount. What are your thoughts on that?
I think it really is, like you said, it's just them pretending like they're doing something, right? I don't
Yeah,
know how much of an impact that's going to have on the actual market itself,
yeah,
right? Because a lot of these people, really what it's going to do is potentially take away money from builders who are building houses and selling. They might be able to lose out on some tax, right?
yeah.
So that could actually be a worse thing in some cases for some people where they'll have less an incentive because they have another a bill to kind of figure out and plan for.
You
So
mentioned something very important there, incentive. Like in my opinion, I think the main thing here is there incentive to sell?
yeah.
Because if I'm paying a lot of tax every time I sell a property, do I
Why
have
would I?
any incentive to sell?
Yeah,
So I think the question we need to ask ourselves is what happens if there's no incentive for investors to ever sell that property?
yeah, yeah,
That supply is permanently taken out of the market.
yeah. Now, we could sound like conspiracy theorists with these red tapes on each thing, but if they really all tie into each other,
They
right?
do,
Now,
they do.
if
Yeah,
we've got people that are in the upper end just selling their property and not investing, and the other ones that have done really well, like you said, when they purchased a property a few years back and they're positive, the
yeah,
people that everyday Australians that are trying to buy, they can't afford it. And the top 1% are the prices that are going down where they can even buy even more. So, it kind of feels like even a wealth shift potentially that could even happen.
it's
So
happening, man.
it really
100%. Yeah,
and now if I'm gonna go buy a house and try to flip it and not make it work, why would I sell it to someone else? And you're just gonna be, it's gonna be like a club where you either can get in or you can't. And a
exactly.
lot of these
Yeah,
changes, it just feels more like that. An incentive, like we said, the word incentive, right? People aren't getting incentives to invest. They're actually getting hurdles, and it's making it harder and harder to invest.
yeah.
Where the people that are already there and have already reached that threshold or really got an investment portfolio, they're actually benefiting from a lot of these things.
Yeah, I think the last thing you said, I think there is a lot of incentive to invest, in my opinion,
Yeah,
because I
yeah,
think we know that I think everyone would agree long term that prices will grow. So
100%.
I think the incentive to invest in Australian property will remain the same. I
Yeah,
think back to the point of if I hold a property today and I'm paying a lot of tax if I sell this property. But while I'm holding it, this property is growing and I can then refinance and I can take an equity and I can keep expanding my portfolio and these will grow even more. And then now I've got assets
yeah,
that I can keep getting this wealth creation and the snowball effect rolling from the equity I gain. Why would I sell these assets?
yeah,
Because they're all growing in value. I can tell you something like even right now, for most of our investor clients, there's very little incentive to sell anything because this is not even without this. This is without this this
yeah,
new CGT change. This is as normal as things are
yeah,
today. Why is that? Because We were getting into these markets when they were priced 20, 30, 40, even 50% lower. If I've got clients that want to sell a property today in Perth, for example, they'll get 300, 400 grand profit, yes, but then they still want to be in the market. What do they buy next? Well, buying capital city under 800 grand is going to be close to impossible soon in major capital cities. So
Mm.
it's like, well, yeah, I can sell this asset, but then where do I put my money in next?
Yeah. Yeah.
Yeah, if I go back to Perth, I'm buying the same location and paying the same price I paid to sell anyway. So I'm buying
Yeah.
the same property back from someone else.
Yeah.
So
Yeah.
does that make
And
sense?
the
Probably
reason,
not.
yeah.
Yeah, because I'm paying tax on that. I'm paying stamp duty to go back in. I'm losing money then. So
Yeah.
right now, even right now, there's no incentive to sell. And
Yeah.
when there's no incentive to sell, you've got all these buyers coming into the market trying to secure assets for long term. And if you even reduce incentive to sell even more, every house that an investor buys or owner occupies that buys today, that's supply that is permanently gone from the market in a market that we have a historic supply crisis.
Yeah.
So these are things I think the government really needs to think about because right now investors they're happily selling properties every 5, 6 years, in my opinion. From what I'm seeing, I think that's a very common theme. In some markets, they're selling even after a year or two. But the good thing about that, at least that there's creating that constant supply, especially in the existing market space. But having this policy come through, you're really incentivizing investors to never sell.
Yeah.
Keep leveraging equity, keep building your portfolios, but you hold these properties for as long as you possibly can because you know
Yeah.
if you do sell something, hey, I'm going to pay a lot of tax. And a lot of people they can just hold it out because if you do all the numbers correctly, you can hold multiple properties. Maybe you hold this thing out if they do change this policy until they change it back again
Yeah.
because I don't think this will be a policy that lasts too long, in my opinion, because
Mm.
they kind of just get away with taxing everything for no apparent
Mm.
reason every single time. So, but like that's just my opinion. But like you can have that mindset. So I think the
Yeah.
government really needs to think about again, instead of trying to address the housing crisis when in like these kind of phantom policies to not really address the main issue of supply and demand, you're not really
Yeah.
fixing anything.
Yeah.
And in a
Yeah.
lot of ways, these have very counteractive measures that make it worse.
Yeah.
So just yeah, like it's I think a lot of fear for no reason, in my opinion, man.
Yeah.
Yeah, you're saying something?
I think the focus should be more on trade and supply and
Yes.
builds, right? And I think WA is one state who's struggling the worst with this, but I
Yes.
think trying the hardest,
Yeah.
right? Now they had the incentive, I'm not sure if you heard, where if you move there with a trade, they would give you $10,000 on certain
Yep.
qualifications, right? That should be the focus. And as an
Correct.
investor, I barely know how to use a left-handed hammer. I don't know how to fix things, right? I'm gonna just assume the professionals know. But if we just don't have the physical professionals to actually look at it, I'm actually being punished and not able to develop my properties and expand my portfolio. So like you said, I'm just going to be hoarding ready to made properties and I'm not going to really bother trying to develop it because, with properties and a lot of strategies that I use with my clients is actually buying a property and potentially flipping it, not selling it, waiting for the tax advantages. So if these things are getting cut out, like we said in the beginning, people are going to get more expensive houses that are worse and lower quality and I have less than an incentive to fix it properly, I'm just going to put a band-aid on it because I don't have negative gearing, right? And if I sell it, I have to pay more tax. I don't get any back from the capital gains that we got before. So all these things aren't really helping the people that actually make more houses, right? Now, if you forced certain companies and certain builders, if they got certain jobs, they had to build certain houses, maybe that's something that they could do, or, something creative in terms of making it easier for builders. But I hear of some councils making regulations easier, but in certain pockets that we're buying, I know there's a lot of attention around Central Coast and Newcastle. They've
Mhm.
been one of notoriously worst councils to actually help and develop properties and buy properties and
Mm.
and work with.
Yeah.
So if the government just can't handle it, then how is, taking away money from investors going to make it better? That's just what I don't really understand.
Yeah. Agree, man. Like I think there's just been minimal thought process ultimately into
Yeah.
these policies, and it's created a lot of fear. And I think you
Yeah.
asked me before the podcast, like, are you seeing people scared? Well, our clients who are signed up, they're not scared. They
Yeah.
understand that this is probably the best decision they can make from an investment point of view. I'm
Yeah.
not saying you outperform every asset in the world by any means, but it's
Yeah.
safe. You know that
Yeah.
you'll get the growth. It's a safe place to put your money, and it's a proven asset. It's a
Yeah.
proven asset despite all of the geopolitical tensions, any worldwide global uncertainties. Property always performs, especially in the long term. So for clients that are onboarded, yes, they're very confident that they're still going ahead. But we have a lot of conversations with potential clients, and there's a lot of fear in the market. because I don't think they understand the overall, economic space, and that's fine because it is very confusing and difficult, and you see crazy headlines all day just to, strike fear in you every single time. But yeah, we've had conversations with clients, more comfortable buying like Bitcoin or buying equities in the share market. And one of our predictions this year is that Australian property will again shine as the safest growth asset in 2026.
Yeah.
We believe the equity markets will correct. It's already happened. It started. Crypto's corrected massively since we did those predictions last year as well. So, like so far, we've been proven right. And if you just look at what's happening in the world, and you'll see how overvalued other markets are, you will see the benefits of how safe investment property can be, and when you get that growth, how much you can expand and build your generational wealth. And again, it's a proven asset, especially in these terrible times. So if you look back like at all the major recessions, all the economic crises going back 40 years, the most Australian property has ever corrected is 8%, and that was in 2008 GFC.
Yeah.
But if there was something big coming this year and the property market corrects 8%, well, what were the other markets doing? The share market was correcting more than 50%. And 8% doesn't mean again every suburb corrected 8%. It just means that's
Yeah.
the median price points declining, again, driven by the more unaffordable locations. So I think there's a way to look at this in a more calm way. Ignore the noise. There's a lot of changes happening in the world today. And we spoke about last week, how AI is going to take a lot of workforce away. So it's really important to get ahead financially. And
Yeah.
one way you can do that is leverage property. So yeah, that's my closing thoughts, man. Just like do what's in your control and just be confident by looking at the historical performance of the asset, understand, what's the safest way to get returns today, and talk to experts if you need to. That's it.
Yeah, yeah, and not just blindly looking at graphs for 100 years and saying, "Oh, okay, it's going to keep going up." Now, one thing that you were alluding to was property just being so predictable, right? And so safe. That's why we really are so big on it. And if we've got the right fundamentals, we really can predict and see how much we can leverage and how much we can get in return. And one thing that's a constant is rent going up. That's one thing that other assets don't really have. You can't guarantee an income that's going to guarantee to go up. There's no other asset that really exists like that where
Correct.
we've never seen throughout history rent actually crash in major cities in the country. So that's one thing that gives us the confidence that we can predict our investments and our risks as well as best as we can.
100%, man. You've got an asset class that essentially that rent goes up, it pays off your mortgage, and you're leveraging your money to get growth. So
Yeah,
yeah, it's a
exactly.
way to beat the game for
Yeah,
sure.
exactly.
Yeah.
Exactly.
That was a good catch up,
So
man, Phil. Like I know we covered
it's
some like high end topics today, but
definitely.
definitely need to be done today for sure.
And it's good to hear the insight as well for the clients that, they are still feeling confident. So we
Yeah,
know there's light at the end of the tunnel. There's no real, extreme headlines that are going to scare us.
correct. Well, we'll catch up soon, man. Appreciate the time today.
Sounds good, man. See you
Cheers, man.
later. Thank you.